Hello guys, welcome back. Hope you all are doing well with your studies. So in this particular video, we are going to talk about money market. So in our previous videos, we generally talk about financial market, what is financial market and the different type of financial market. And we already cover money market and the capital market and the major the basics or as well as the major tools which we generally use in capital market. Okay, so now in this particular video we are going to talk about money market and their instruments. So this, I hope this particular chart is clear to all of you. Okay, so we have financial market. We have two type of market. One is money market, another one is capital market. Capital market, which generally known for the long term buying and selling of securities, and money market, which is generally known for short term duration. Okay, so any borrower, it can be government of India, it can be any corporate house or any investor. Okay, so in money market, the instruments are generally for short term duration, which means less than 1 year, and in capital market we have instruments for long term duration, right? So we already cover what is primary market, what is secondary market, what are equity, debt, mutual funds, different type of bonds, different type of mutual funds, so which we already covered. Okay, now we'll talk about capital money market and the various instruments of money market here. Okay, so I hope you guys are aware about this particular definition. So definition is very clear. Okay, so money market where from where companies and government can raise short-term funds. Short-term funds means up to 1 year. So let's say if government of India need funds for any short-term project, which like if they need funds for to meet their short-term requirements, so they can borrow money from money market. Or same as if any company or any bank, if they required funds for short-term duration, so they can also approach to money market. If you talk about the market regulator, so majorly the activities in money market are governed by RBI. So we already discussed that organized and unorganized money market. So unorganized, like we have chit funds and on, so where we have different guidelines. But if you talk about the organized product, so the major market regulator is RBI, Reserve Bank of India. Some part like short-term mutual funds and all that is generally governed by SEBI. Okay, so money market is basically a market from where companies and any other entity or any participating entity, they can fulfill their short-term requirements. And investor, they can make a short-term investment in this particular market as well, right? So if you talk about the participants, we have number of participants here. Like government of India can participate in money market, which means they can raise funds through money market. We have bank and other financial institutions like NBFCs, mutual funds and other. We have public sector banks and public sector organizations. We have private organizations. So these entities, they can raise funds. To raise that particular fund, they generally issue some securities for short term duration. Okay, and if you talk about the instruments of money market, so whose maturity is less than 1 year, so instruments are like these are kind of, we can say, these are certificate, these are promissory note kind of. Okay, where the issuing authority, they make some promise, like if like in case of treasury bills. Okay, treasury bill is generally issued by government of India. So when they issue treasury bills to the investor, they'll make a promise like, I government of India promise to pay this amount at the rate of this percentage, and they'll return this money after 91 days, 182 days or 364 days. Similarly, commercial paper, which are generally issued by companies. So if companies are required funds for short term duration, let's say TCS require 500 crore rupees for 9 months, so they'll issue some certificate in the market where they'll make some commitment, they'll return this money at the rate of this percentage, and they are generally issuing these particular certificates to investors, and investors in return they are getting some rate of interest from these particular investment. So we have number of instrument in money market like treasury bills, we have commercial paper, certificate of deposit, call money, notice money, term money, and all. Okay, so we will discuss these particular instruments one by one. And one thing, guys, like these instruments are basically these instruments are classified on the basis of the issuer. Okay, so if RBI or Government of India issue, that is called treasury bills. If any bank or any financial institutions, when they issue these kind of securities in money market, they call certificate of deposit. When two bank or interbank transactions are happen for the short term, then it is called call money, notice money, term money. Okay, similarly for companies they use commercial paper. So first instrument we have, that is called treasury bills or T bills. So T bills are issued by Government of India, or we can say the promissory authority here is Government of India. As you can see in this particular image, so the promise is generally made by Government of India. These are issued by RBI on behalf of Government of India. RBI is generally known as bankers to the Government of India, because like whenever Government of India needs short term or long term requirements or funds, so they are generally fulfilled by the RBI itself. So on behalf of RBI, sorry, on behalf of Government of India, RBI issues some securities in the market, and these are generally known as treasury bills. So if it is for short term, they call treasury bills. Long term, we have number of bonds and all. Okay, so issued by Government of India. If examiner asks you who issue treasury bills, your answer will be Government of India. These are very less risky in the nature. Now, what is risk and return portfolio? I hope you know the risk and return payoff. So let's say this is risk and this is a return. Okay, so if there is a high risk in any product, so your return will also higher side. If there is a low risk, so the return will also less. Okay, so whenever you study the risk and return payoff, so higher the risk, higher the return, lower the risk, lower the return. Okay, now for all, if you when you'll study the different instruments of money market, you'll get these kind of statement. Okay, so now here, as you can see, these are very less risky instrument. Why these are very less risky instrument? Because these are issued by Government of India. Okay, so the promise is generally made by Government of India, and we do have that surety, because like government is not going to make any false promises on these kind of instruments. Okay, so these are sovereign kind of nature. Okay, sovereign in nature. So the promise is generally made by the central government of that particular country. Okay, so treasury bills, here the promise is generally made by Government of India. So these are least risky instrument in money market. So there is no or very less chances of default, because if let's say is if Government of India or any government issue these kind of instrument and they won't be able to fulfill their promise, which means the whole economy is become defaulter. Okay, and here like if you see the past 50 years, 75 years, so there is a very rare chances of these kind of events in the market. Okay, so that's why these are very less risky. Now if we have less risk, the return will also very less. Okay, so many time examiner they generally ask which one of the following is least risky or least return oriented instrument in the market. So your answer will be treasury bills. Treasury bills are, whenever we issue treasury bills, so the per unit cost is 25,000. So let's say being a buyer, if any institution who is participating in these particular treasury bills, so their cost will be 25,000 per unit. Okay, let's say if they buy 10 unit, so 25 into 10. So whenever like let's say if they are buying 1000 units, so it is 25,000 into 1000. So this way, so your investment or your denomination is 25,000 and multiple in case of treasury bills. Types, if you talk about the types of treasury bills, so types is nothing. Basically, treasury bills are issued in three different time duration. One is 91 days, another one is 182 days, and third one is 364 days. You can just double it, okay? 91 double 182, 182 double 364 days, and this way you can remember this one. Sometime or previously it is also issued in a time duration of 14 days, but nowadays RBI do not issue in 14 days tenure. Okay, so whenever we issue treasury bills, whenever government of India come with this particular sale, so they generally issue these particular instrument in 90 days and the multiple. Okay, so 91 days, 182 and 364 days, which means the maturity of this particular instrument is already mentioned on that particular instrument. Okay, let's say if you buy this particular instrument, so I government of India promised to pay this amount after 91 days or after 182 days or after 364 days. So the maturity period for these particular one, so after 90 days, let's say if the instrument is 91 days, so after 91 days investor will get their money back. Okay, so this is the instrument. So this way you can remember the facts about the treasury bills. Hope this is clear to all of you. So still, if you have any query, do mention in comment section, right? Let's move to next one. So next we have commercial paper. Now commercial paper, these are generally issued by companies or corporate houses. Okay, so let's say if any company who need funds for short term duration, let's say TCS need funds for short term duration for 90 days or for 180 days, so they can issue these kind of instrument. As you can see, the commercial cable company, so they issue this particular notice that is called commercial paper. Commercial paper, now these are generally issued by corporate houses or companies, so there is a high chances of default. Okay, if you see the highest or the highly risky instrument of money market, so your answer will be commercial paper. You have so many examples where some good companies, like we have Kingfisher Airlines, we have another Satyam Computers and all, so they generally become defaulter in a span of time, within 2 months, within 3 months, when their loopholes come in the public. Okay, so that's why these are very risky in the nature. So if they have risk, they have higher return as well. Okay, so risk and return, you can say these are highly risky instrument. Denomination, like now I hope you guys are aware about the denomination. So denomination is 5 lakh and multiple. So if any buyer who invests in commercial paper, so their investment will be 5 lakh and multiple, in multiple of 5 lakh. Like if they buy 2, so their investment will be 10 lakh. If they buy 3, so their investment will be 15 lakh. Okay, time duration, if you talk about the time duration, so they are generally issued for a minimum period of 15 days and for a maximum period of 364 days. Please do remember this particular part. So many times examiner, they generally ask question based on commercial paper as well. Okay, so commercial paper, these are basically these are debt instrument which are issued by companies or corporate houses. It can be private or it can be public as well. Okay, so they are issued for a minimum period of 15 days and maximum 364 days. In between, they can issue for 290 days or any other period. Okay, so they are, if they have short term requirements, they'll issue these particular instruments in the market and they'll raise fund for a the rate of interest, which is like we can say prefix on these particular instruments. These are risky in nature because there is a probability of default by these corporate houses. Okay, so hope this is clear. Our next instrument is certificate of deposit, CDs. So CDs are generally issued by banks. As you can see, this is issued by Bank of India. Okay, so certificate of deposit, these are issued by banks and commercial banks in India, basically scheduled commercial bank. Their denomination is rupees 1 lakh. Now, if you come to the risk and return payoff for the certificate of deposit, so what will be your answer? Your answer will be moderate. These are moderate risk and return. Okay, so why moderate? Because they are less risky than commercial paper and they are more risky than treasury bills. Why so? Like if you study any economy, so like the topmost security which is generally provided by the government, then we have, if you see the defaults, so like there are so many companies who become defaulter in last 5 years, but there are very few banks who become defaulter in last 5 years. Okay, so that's why if you go through the risk and return payoff for certificate of deposit, so that is medium. Okay, so moderate risk and return. And even if you see the return size, so you'll get more than your treasury bills but less than your commercial paper. The time duration, so whenever certificate of deposit are issued by bank, they are generally issued for a minimum time of 7 days and a maximum time duration of 364 days. So minimum 7 days and maximum 364 days. In between, they can issue for any time duration. It can be 100 days, it can be 200 days or 300 days. Okay. Next instrument we have next three instrument we have call money, notice money and term money. So before coming to call money, these all instruments are generally known as interbank transaction. Okay, so call money, notice money and term money. So you will find a word that is called interbank. So what is interbank? It is bank to bank transaction. So okay, so let's say a bank ABC who need fund for short term duration and they approach to XYZ bank. Okay, Punjab National Bank need fund and they approach to State Bank of India. Now on the basis of that time duration, let's say if they need fund for overnight, that is called your call money. So interbank means there is a dealing between bank to bank. Okay, like in other cases like treasury bills, we have issuing authority government of India, but the buyers are different. Institutional buyers, we have banks and others. In case of commercial paper, we have the issuing authorities corporate house, but these are generally purchased by other companies or other wholesalers or the financial institutions. Okay, but in case of call money, notice money, term money, these are interbank transactions where the seller is one bank and buyer is another bank. Okay, so if any bank required money for overnight means 24 hours. So if they need some urgent money and they are borrowing this money from another bank, so that is generally known as your call money. Okay, so here we do not have the fixed denomination because it is a requirement of bank. It can be 5 lakh, it can be 5 crore or it can be 50 crore as well. Okay, and even you cannot classify the risk and return, so that is moderate level because the involvement of bank as well. Okay, and the rate of interest is again that is decided that is totally based on the negotiations of these banks. Okay, so call money is an interbank transaction for overnight 24 hours. Similarly, notice money, it is for 2 to 14 days. It is an interbank transaction for 2 to 14 days. So when a bank need money, they borrow money from another bank for 10 days, 12 days, 14 days. So this particular transaction between two banks is generally called notice money. Third one is term money. So term money, the time duration is 15 to 364 days. Again, an interbank transaction between two banks for 15 to 364 days. Okay, so let's say State Bank of India borrow money from any other bank like PNB for 300 days. They borrow 500 crore rupees. So this particular transaction is generally called as term money in Indian banking system. So hope this is clear to all of you guys. So call money, notice money, term money, all are your interbank transaction, and the participants are two banks. One is borrower, another one is lender. Okay, so if it is happened for overnight, it is called call money. If it is for 2 to 14 days, it is notice money, and if it is for 15 to 364 days, the transaction is generally known as your term money. So guys, like if you talk about the participants, like we have borrowers who can borrow money under call, notice and term. So we have scheduled commercial banks, we have cooperative banks, we have primary dealers. So these are the borrowers, and lenders who can lend money in this money market or call money or notice or term. So we have scheduled commercial bank, cooperative, primary dealers, select all India financial institutions, insurance companies, mutual funds. So these are generally lenders in this particular market as well. Okay, so hope this is clear. So guys, in this particular video, we generally talk about what is money market. So money market is basically a market which generally fulfill the short-term requirements of companies as well as government. Okay, if any company or government they need funds for short-term duration, so they can approach this particular market. We have different instruments as on the basis of their issuers. So, like if it is issued by Government of India, it is called Treasury bills, and they have some different feature. If you talk about the if it is issued by any corporate house, it is called commercial paper. Okay, so every product or every instrument, they have some different features like a risk and return payoff, like their denomination or their issuing body. So you need to remember those particular areas for your examination viewpoint. So hope these particular things are clear to all of you. Still, if you have any query, please do mention in comment section. So I'll revert back your queries. Okay, and if you like the video, please do share with your friends. And if you are new to my channel, please do subscribe. So this is it for this particular one. Thank you for watching this video, guys. Bye bye. Take care all.